Before we get started, let me take a moment to introduce myself. I am Brian Peller. I am one of the certified credit union financial counselors here at AFFCU. And with me is Jimmy Dickerson, and I'll let him introduce himself.
Hi, everybody. My name is James Dickerson. A lot of people call me Jimmy. I am the Director of Member Experience here at Atlantic Financial. I'm really happy to be here with all of you. Brian and I usually do these things in person, but you know, with COVID-19, we're moving everything online. I know a lot of you guys have met us before, so thank you all so much for joining us. I wanted to just mention, Brian and I talked about it before we started, since we saw a lot of familiar names. If you're finding value in these and you've signed up for additional seminars, we really appreciate that. We love that you guys enjoyed them enough to come back and see us for a second and sometimes a third time. On top of that, we would love it if you invited any of your friends or family or anybody that you feel like might benefit from it. They do not have to be an Atlantic Financial member in order to participate in these seminars. We hope that through interacting with us, they find the value in membership and decide to join Brian to sign up for membership, but they do not have to be a member to participate in this and get the information.
Absolutely. And Jimmy, at the end of the conference, at the end of the webinar, will show you exactly where you can see all of the webinars that we have scheduled for the month of May. So let's go on to the next slide. Credit. Dun, 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 dun. And credit obviously is your ability to borrow money. The better your credit, the more money you can borrow and at the less interest rate. There is almost always a charge for borrowing the money that's either in the form of fees or interest or both. And like I said, the better your credit score is, the less you're going to pay in both interest and fees. So is your credit score excellent, average, or poor? Real quickly, I just want to give you here what is considered the number. And that is, if you have an excellent credit score, it's above 760. Very good is 725 to 759. Good is 660 to 724. And fair is 560 to 659. And poor is anything below 559.
Yeah, that you know, and I think it's also important to note that every institution, every lending institution has their own brackets. That's a rule of thumb, numbers that Brian just gave you guys. But every institution has its own brackets on what they consider, what we rate credit on an A to F schedule, just like school grades, what an A or an A plus credit score is, or what a B credit score is. It ranges in every institution.
And you're going to hear us both say this a couple of times. That credit score is a living and breathing thing. So if today you're at 640, that doesn't mean that in a year you won't be in the 700. So we're hopefully going to give you some ideas of some things you can do to get that credit score up. Some of it may be more painful and harder to do than other things, but we'll touch on some of those things.
Absolutely.
So what makes up your credit score? Well, the number one biggest factor is your payment history. Do you pay on time? And I can't stress that enough. Do you pay on time? That is the number one thing. But there are some other very large and important things as well. The amounts owed. And that is two different ways. That's either the amounts owed compared to what you make, what's called your debt to income, DTI, or it could be the amount you owe compared to your credit line, and that's called utilization. And Jimmy's going to go over some examples of where they should be in a second. Credit length. How long have you had your credit? What's the average length of time? The longer, the better. When you have a lot of brand new credit, your credit score is dinged a little bit because they don't have time to evaluate it. Types of credit. What is your ratio of installment loans, like car loans, home loans, to unsecured loans, such as credit cards? And finally, new credit. If you go apply for a bunch of credit cards, or every time you apply for a credit card and get approved, that's new credit. And initially, you take a little hit to your credit. In the long run, it's not a big deal. When it becomes a big deal is when you do 15 new loans all in the same month. That's when things become alarming and you take a bigger hit to your credit.
Yeah, and what Brian was talking about a little bit at the amounts owed, he's talking about credit card utilization. So you really want to make sure for optimum credit growth, for the optimum increase in credit score, you want to keep your credit card utilization at 25 to 35% of the overall credit line. So that means in an example of $1,000 credit limit, you don't ever want to go above $250 to $350 owed on that card at any given time, if your goal is to increase your credit score as quickly as possible. And you really want to try and stay under 50% all of the time, because anytime you go over 50% utilization, it starts to negatively impact your score. Now, it's the same scale. So, if you're at 52%, it's not going to have as negative of effect on your score as if you're at 89% of your credit limit. So the higher over 50% you get, the more negatively it'll affect your score. And when Brian is also talking about new credit, he's talking about inquiries also. So anytime you apply for something, there is a possible negative effect to your score. We talked a little bit about this in the home buying seminar. It's always a concern when folks are applying for a mortgage. How's it going to affect my score? How's it going to affect my score? And if you apply for one or two things, it's not really going to have a major impact. But if you're applying for 5, 10 things in a month or in a few months, that can have a negative impact on your score. So it's important that you're limiting the amount that you apply for things, but you also aren't fearful of the idea that you need to submit an application if you in fact need to submit an application.
Absolutely. So what's on your credit report? You need to actually look at your credit report, and you are entitled under federal regulations to get a copy of your credit report. It doesn't have your credit score, from all 3 major credit reporting agencies. And you can go to this annualcreditreport.com to get that report. And this is the only place where it is your true credit report, and that is completely 100% free. There are things like Credit Karma and other ones that you can join that say that they give you all this stuff, but it comes at a cost. So here, it is completely free. The first time you go, I think both Jimmy and I both recommend the first year you get all 3 at one time, so you can take a look at them, make sure everything is right. After that, we recommend getting one of the reports every 4 months. A lot of the lenders and creditors report to to all 3, but some of them only report to one of them or 2 of them. So it's really important to check them all to make sure. And we'll talk about what to do if there's problems later on.
Yeah, and like Brian was saying, this is the only place you're going to get a full, accurate report. And people always say to me, oh, I check Credit Karma and I check Credit Sesame and I, this, that, or the other thing. I get my credit score in my credit card statement or, wherever you're getting this information from. And it's not to say that that information is inaccurate. It's to say that it's not the full picture. And the only way to get the full picture is to use this platform. And especially when you go to like freecreditreport.com or, these other websites that like say that your report's going to be free, they charge you for this or they charge you for that. Or in Credit Karma or Credit Sesame's world, then if you guys have ever used their app, they're always like, oh, we have a recommendation based on your report to apply for this credit card. And, it's beneficial to help you pay down your, no, that's a paid sponsorship that credit card company paid Credit Karma to recommend their credit card. So, the advice you're getting may not necessarily be what's best for you, but, who paid the most for that potential sponsorship?
All righty. Credit reports. There's 5 information zones on a credit report. Your personal information, your credit scoring results and summary, trade lines, derogatory accounts, inquiries, and public records. I'll go briefly into each one of these. So your personal information is just that, your name, social security, maybe your address. These are things that identify you. They are not included in the credit decision. None of those things are used, your race, religions, where you work. None of those are actually used in a your credit score. The second one is credit scoring results and summary. This is where your credit score is shown if you get one with a credit score, and it's a summary of the major contributing issues that'll explain why your score is where it is. The third thing is trade line and derogatory accounts. This is the largest part of the credit score. This lists every creditor and lender that reports your loan or line, the amount of the line, how much you owe on it, if you've been 30 days, 60 days, or 90 days late. All of those things are here line by line. And derogatory accounts are things like if you have a medical bill that went unpaid, things like that are also listed here. Inquiries is just that. That is any place you applied for credit. It shows here, and it can be used in your credit score. The more inquiries you have, you get a little ding for each one of those. And then there's public records. Those are things like bankruptcies. If you not paying child support, those kinds of tax liens are all in public records.
Yeah, anything that goes to court, it goes into the public records category.
Yes. So what's the difference between a hard credit pull and a soft credit pull? You probably have heard those terms. So in a simpler way than trying to read this chart, a hard credit pull is simply anytime you go apply for credit, they do a hard credit pull, and that is then becomes an inquiry. And if you get approved and you take the loan, that then becomes a new account. The soft credit pulls are things like you get in the mail, you've been pre-qualified or pre-approved. They've taken a soft look at your credit report. That does not affect your credit score. Also, people that you currently have credit with are going to look here and see if you owe, what's going on with you as far as how much debt have you taken on since the last time they looked. And you could get an increase or a decrease in your credit line. And that's all done through a soft credit pull as well.
Absolutely.
The 5 C's of credit. I've been in the financial world for 20 some years. Jimmy is our subject matter expert here. He has worked in lending departments and made lending decisions in the past. I'm going to briefly give you a description of these 5 C's, and then Jimmy's going to go a little bit deeper in them. So character is just that. It's how long you lived at your current address, how long you've been at your current job, whether you have a good record of paying your bills on time and in full. Capacity, that's the lender needs to know, do you have the ability to comfortably, and that's the word, comfortably, repay this loan? How much, what is this going to do to your debt to income ratio, this new loan? And they can look at all types of income for this capacity. Capital. So while capacity looks at your primary sources of repayment, usually your income, capital looks like what else do you have available to you to help you pay this loan if something happens to that primary source of repayment. So that looks like it's savings and investment accounts and things like that in order to help with the repayment. And then collateral, those are for secured loans. So that's like a car loan or a home loan. What are you offering up to the lender that they can take from you if you can't make the payments to try to recoup their money for the loan? And then conditions are things like what kind of loan are you applying for? What's the reason for the loan? Is that reason something we lend money for? It also can be in order for us to approve this, we need your past 2 pay stubs, or we need some sort of proof of your job. If you had a problem, we might need a letter to satisfy what happened then. Those are conditions.
Yeah, that was everything that I usually mention, Brian. I think that the other thing that I would mention, though, is that each of these 4 or 5 categories can be used to compensate for another. So in the situation where you have an unsecured loan, there's no collateral. You apply for a credit card, you apply for a personal loan, we don't have any collateral. So what we then do is we take your capacity and your character and we boost those up on another, I lost it. Yeah, we boost them up higher in the underwriting process. So we're gonna look at your your character and your capacity with a little more scrutiny than we might if we have a collateral, right? Yes. And if we have a really good collateral position, so meaning, let's say you own you're financing a car that's worth $10,000, and you bring in a great big down payment of $5,000. So we're only financing $5,000 on a car that's worth $10,000. We may be less restrictive on your character, meaning your payment history, your time on the job, your previous credit experience. And we may even look with less scrutiny on your capacity, meaning we might let you go higher in your debt to income ratio, meaning borrow more than what we would typically let you borrow, because we know that if you didn't pay it, we could still recuperate those funds from the collateral. So each of these can be considered what we call compensating factors.
We did get 2 questions on this screen, so before we move on, let's quickly address them. The first one is, how does the credit bureau know how much capital I have?
Well, so the credit bureau doesn't know how much capital you have. And we're talking about the 5 C's of credit right now, so I can see why that would be a little confusing. Capital, collateral, capacity, conditions have nothing to do with your credit score. Those 4 C's, your credit score and your credit history, all fall under the C of character. The other 4 C's are what an underwriter or a lender is looking at in a decision-making process. So it's not about your credit score. So the capital you have doesn't improve your credit score. But if you had a poor credit score, for example, but you had a lot of cash on hand, then you may be more likely to be approved for a loan by an underwriter. So it doesn't impact your credit score, but it can impact your ability to borrow.
Right. So in this case, what would happen is the lender is probably going to ask you for copies of your bank statements. That's how they know how much capital you have. But that's to a lender, not to the credit bureau.
Yeah, that could be if you were purchasing a home. Sometimes if your credit isn't where they want it to be, meaning like, you don't have a really strong credit history, or you don't have a lot of payment history, you have previous payment history difficulties, then they could say you need to have a certain amount of money in what they call reserve funds. Reserve funds meaning the funds that you have outside of your closing costs and down payment. We want you to have an additional $10,000 that you have in an account somewhere else as reserve funds, so that we know that if you lost your job or if something happened, you have funds to fall back on to help you make your mortgage payment.
Correct.
So that's an example of capital being utilized in an underwriting decision.
Our second question is, does conditions include interest rate?
So no, we wouldn't condition an interest rate. Your interest rate is typically in a risk-based pricing model, which most lenders use, based on your credit score or your credit history. So for example, we might approve you for $5,000, but because your score is 650, your rate's going to be 7.99. But if your credit score was 725, your rate would only be 4.99 for the same $5,000. That's what's called risk-based pricing.
Yeah, so your interest rate is part of the agreement. Conditions are things that are done to make a decision. So once a decision is made, then they decide on your interest rate, and that is in your agreement that you get. You could say, no, I don't want this credit card at 19.99% interest, but that's not a condition. Your interest rate is the outcome after they do the 5 C's of credit.
Yeah, I usually compare a condition to an if-then. If you pay off this credit card with the loan, then we'll approve you. If you're willing to put $5,000 in a savings account here, then we'll approve you. If you provide us with pay stubs, we'll approve you. Conditions are usually if-thens.
Right. Very good. That were great questions, both of them. So the effects of negative credit. This is the slide that always hits home for me, and that is when your credit score is lower, you wind up paying more overall for whatever you want to buy by both having higher APRs and higher monthly payments. And APR is your annual percentage rate, so it's your interest rate. So let's say, for example, you want to borrow $15,000 and you have excellent credit. You might get an interest rate of 5% and your monthly payment will be $352. But let's say you just have good credit. You're going to go to 10% interest, double your interest that you're going to pay, and $391 in a monthly payment. And let's say you have fair credit, and you can even get approved for the fair credit, you're going to go to 15%, 3 times as high as the excellent credit rate, and pay $427. Now, it's kind of a shame because obviously if you have fair credit, you're having some issues. You're probably the least likely to be able to afford higher interest and higher payments. But from an underwriting point of view, it has to be this way because you're the greater risk of not getting their money back. So they're going to try to get as much money back up front in some ways as they can. So that's why you see these. So that is why it's very important to continue to monitor and to continue to work on a better credit score.
Yeah, and just to continue what Brian said earlier about the credit scores being liquid. If you need to get a car today and you're going to pay more money because of where your credit position is, it doesn't mean that you're stuck in that situation forever. If you, over the next 12 months or 24 months even, increase your credit score through positive payment history or mitigating collection accounts or just overall better credit behavior, then you can always refinance those loans at a lower interest rate at a later time. You're not locked into those lending contracts. So it's important that you look at lending products that are fully amortized. Fully amortized means that you pay the interest over the entire life of the loan. A non-fully amortized loan may have interest is what we call front-loaded, which means you pay the interest up front before you start paying on the principal. Those aren't really great lending products, especially if you're trying to improve your credit score or trying to increase your credit ability so that you can refinance later. You don't want to pay all that interest and then it not be beneficial to refinance later.
That's right. And I'll say my budgeting comments for later on. So
that's good.
So again, here's more problems when your credit score, this is how your credit score winds up taking a hit. You have excellent debt to income, you have excellent utilization at 25%, you're paying your bills on time, and your credit score is an excellent 780, great score. But after just one of these following things happens, your credit score can take a big hit. If you max out a credit card, you go above that 50%, or you go all the way to 100%, your credit score can drop to 735. If you're 30 days late on a mortgage, your credit score can just drop to 670. If you wind up settling a credit card debt, and that means you don't pay it back as promised, you somehow work out an agreement where you pay less than what you originally owed, or you don't pay as much interest, your credit score can drop to 655. If you have a foreclosure on your home, you can drop to 620. And if you have a bankruptcy, you can drop to 540. So there's a couple of things I want to say here. First off, the settling credit card debt, foreclosure, and bankruptcy, those are the three biggest things. And if you're starting to have trouble, you should start talking to either a counselor or talking directly to your creditors about working out arrangements. The last thing you really want to do, if you can avoid it, and sometimes it's not avoidable, but if you can, so you want to avoid bankruptcy and foreclosure. Now, like we said, now I'll say for the third time, just because you have a bankruptcy today doesn't mean you're stuck in the 500s for the rest of your life. You can start working it back. We have many, many clients who had bankruptcies and they were in the 500s, and after a couple, 3, 4 years, they were back in the 700s. So it can be it can always improve.
Yeah, there is no such thing as your credit's ruined. Your credit, I know people who have had bankruptcy and were buying a house 2 years later. There's no reason to say that you throw your hands up in the air and say, my credit's ruined, I'm done with this. There's always a way to come back. There's always opportunities. It's about finding a plan and finding the right people to support you in that effort. And Brian and I are going to talk about some of the resources that Atlantic Financial offers later. But it's really about, getting the right people in your corner to help you accomplish the things you need to accomplish. Looks like we got a question, Brian.
Any one of these or all of these drop your score to the 500s? So basically the bankruptcy will take the biggest hit to you. Now, what usually happens is not one of these things happen. Usually what happens is multiple things of these things happen. If there's a bankruptcy, you're probably 30, 60, 90 days late on multiple accounts. So your credit score is already tumbling, and then the bankruptcy is the final thing that takes you below that.
So yes, some of these things can drop your score to 500, but most of these things aren't. So like Brian said, if you're 30 days late on one payment, your score is not going to drop to 500. It's going to drop to 670 or 690. Now, if you're late on 3 or 4 things, it might affect your score a little bit more than that. But it's also important to note that the longer and the greater your positive payment history is, the less of an impact one blemish is going to have. So if you've had 15 years of really great credit and payment history, and you have one late payment, you may not even see 600s. You may just see a 715 or a 710. Because you've had such great payment history for so long that everybody has one mistake. They don't they don't blemish your credit for that long. But it's also important to recognize that everything has the worst impact on your credit the first moment it happens. And it starts to affect you less and less and less until it goes away. And we're going to talk about how long things take to go away on your credit in just a minute. But it affects your score the greatest right after it happens, and it slowly and gradually starts to affect your credit less and less. So you may be a 780, have a late payment today, and 6 months from now be back to 780 if you have excellent payment history beforehand and excellent payment history afterwards.
That's right. 1 30-day late is not going to kill you. I think what really, and it's very hard because these are all averages. What happens is that everyone's situation is a little different because everyone's credit is a little different, and there's all kinds of algorithms and computer programs that these companies use to come up with your credit score. It's all electronic, and it's impossible to say exactly what's going to happen exactly, but Jimmy's right. Just like inquiries, the first time the inquiry hits, it takes the biggest hit, and it's only a few points to begin with. But the next month, your credit score starts to go back up little by little as we get farther away from the incident. And I'll let Jimmy do this. This is the slide of how long things stay on your credit report.
So rule of thumb on credit usually is 7 years. So things typically stay on your report for 7 years, with 2 real big, exceptions. I don't know how many exceptions, but there's exceptions. 7 years for most things. Bankruptcies can take 7 or 10 years, depending on what chapter bankruptcy you file. Civil suits and judgments are 7 years. Paid tax liens are 7 years. Unpaid tax liens are forever. The federal government is the one exception to the rule that all things will get off of your credit at some point or another. They are getting their money, and they're not going away until they get it. The only 2 things that are guaranteed in life are death and taxes, and the federal government's not letting you get off without the taxes.
I just want to add here too that in Maryland, every state's a little different. So, but if you live in Maryland, an unpaid tax lien is also forever. Some states will let them fall off, but not in Maryland ever.
In addition to that, collections or charge-off accounts are 7 years. I'm gonna go into that in just a moment, a little bit more in depth. And adverse information, and everything else sort of falls into the adverse information. So that's a late payment that takes 7 years to fully remove from your credit report. And inquiries are considered adverse information, but inquiries actually fall off your report after 2 years. And they start affecting you, like Brian and I said earlier, less and less every month. And that's with all these things. If your bankruptcy filed and you start having positive payment history immediately after, 2 years after your bankruptcy, it's going to be affecting you significantly less than it would have, 24 months before that. So back to the charge-off and collection accounts. This is important information for you guys, and here's why. There's a rumor, a myth, that if I don't pay my collection account and I wait 7 years, it'll just go away. And if you're lucky, that might be true. But what usually happens is you have a collection account. Let's say, for example, I have a collection account at Chase credit cards. I have a collection. And they have 7 years for that to be on my report. But 3 years into that collections, Chase says, I don't think we're going to get this money from James. So Chase bundles my collections with hundreds of other collections that they have, and they sell them for a portion of the balance. So like, I owe them $1,000, they sell it to this collection agency for $100. The collection agency then reports it again. It becomes a new collection. And now that 7 years has started over. So it can go away, but it usually doesn't. So it's better to deal with it, get it taken care of, than it is to just leave it out there and hope it'll go away after 7 years.
Perfect. Exactly right. Fix mistakes. So I believe 25%, and Jimmy knows the number, of all people have a mistake on their credit report. That's why way back at the beginning, we said you got to get a copy of your credit reports, because 25% have a mistake. Now, a lot of them are insignificant, but there could be the same account listed twice. There could be accounts that don't belong to you on there. There could be old accounts that were paid off that aren't reported as paid off or closed. All those things need to be checked and fixed, and on the next screen, when we get there, we'll go over how you can fix those. There it is. So you can go to each of the credit bureaus, and once you have the credit reports, you'll know who they are. They're Equifax, TransUnion, and now I'm going to do the opposite of Jimmy earlier. I can't remember the other one.
Experian.
Experian. I knew it was two E's, and filed the dispute there. So you'll see where the error is, and you'll go to that one, and usually right on their website there is a place to submit it. You also can submit it through annualcreditreport.com. They have a place that you can file disputes. The FTC.gov also has a place where you can get letters if you want to write a letter to. So there's all those ways to report these items, but it's not a quick fix. You don't hit that button and an hour later it's all gone. And Jimmy, go over the timeline a little bit.
Yeah, and there's several ways to dispute things. You can dispute one of three ways. First one is fraud, that it's fraudulent. You can submit a fraud dispute. The second one is a inaccurate information dispute. So that's like Chase says you paid a credit card payment late, but you didn't pay it late. You can dispute it as inaccurate information. And then the third option is, I'm not sure what that is, they need to prove it dispute, which basically puts the burden of proof back on the creditor. So you can basically say, I'm not sure what that is, it might be me, but I need documentation from the creditor. And each way you dispute, they have 30 days to respond. And after that 30 days is over, they could not do anything and it just gets removed from your report. Happy day for all of us. They could submit documentation and then it gets sent back to you and you have 30 days to then respond back. Or they could say, they could submit documentation that the credit bureau deems is enough documentation and the dispute is done and the information remains. So there's really three possible outcomes. Disputes are free. I don't know if we mentioned that or not, but there's no cost to the consumer to dispute information on their credit report. They can't charge you to do that.
Absolutely. So build positive credit references, and this is another name for this this screen should be how to improve your credit score. So we want to build positive credit references. The best thing you can do for your credit is use it carefully and always pay your bills on time. I don't think we can stress enough, pay your bills on time. If you think you're going to have trouble paying your bill, don't wait until you actually have trouble. Reach out to your creditor and say, hey, I'm having an issue. Be as specific as you can about that issue and see what you can work out, because you want to try to avoid paying late. And you can ask them, if you go into like a plan, is this going to be reported to the credit bureau? And you can ask them not to report it. Very important. Consumers are proactive about their credit after problems have occurred, can see significant improvement in as little as a year or two. Here's some more tips. Lenders will want to see at least a couple of recent credit accounts paid on time. If you still have open accounts, use them periodically for things you would buy anyway. Then make sure you pay the bill well before the due date. Carrying balances and paying interest is not necessary for building good credit. Although you want to wait until you get the statement, I believe, because if you buy something today for $100 and you go right home and go online and pay the $100, it's never going to register as you made that purchase. So you want to pay as quickly as you can, but wait. I would wait till you got the bill. As long as you pay before the due date and you pay it off, you should be interest free. If you don't have any credit cards, it may be a good idea to get one, and we'll talk about some options there. Um, Avoid guaranteed approval credit cards. And this is different than a secured credit card, which we're going to talk about. But a guaranteed approval credit card, we've all seen them. They come in the mail saying you're pre-approved or you're pre-qualified. And you go online and you get like a $700 or $300 credit limit at like 29% interest and either an annual fee of $120 or $12 a month. It's very expensive credit. And once you get into it, it's hard to get it paid off and get out of it because they keep adding fees in every month. So try to avoid those. And again, it says, again, the last thing on here, just repeat, is never pay a bill late.
Yeah, and we got a couple questions here, which we're going to answer in just a second. And I lost it. It's gone.
Okay, let's take a look at the questions. Will a dispute increase your score?
So if you dispute something that is negative on your report, so you dispute a late payment or you dispute a credit inquiry that wasn't yours, or you dispute a collections that you paid, then you win and it is removed from your report, then yes, that will have an immediate increase impact on your score, because the moment it's removed from your report, it no longer contributes to your credit score. So yes.
Okay. And then the other one, does a higher credit limit mean higher credit score if utilization is low?
It can. Anytime your utilization is low, it is going to have a positive impact on your score. However, having lots and lots of high credit limits can impact your ability to borrow when you need to borrow it. Because a lot of times when lenders are looking at approving you for like another credit card, they actually max out the credit cards you have to forecast how much you could potentially borrow if you wanted to. So like if you have a $20,000 credit limit with Citi, a $20,000 credit limit with Chase, a $20,000 credit limit with Bank of America, and then you come to Atlantic Financial and you say to us, can I get a $20,000 credit limit credit card? We're going to say, you have $60,000 in available credit now. If we give you $20,000, that's $80,000. You could go out to borrow and buy an $80,000 car with your 4 credit cards and max all these out, and there would be nothing that we could do about it. So yes, having a high credit limit and low utilization will improve your score, but it may, if you have lots and lots of credit limits available, may decrease your ability to borrow other unsecured debts.
Absolutely. Yeah. Yeah. The problem is when you have a lot of unsecured credit limit and they're high, if you need them, it's good to have them that high, but it will definitely, and especially in this day and age, when we're in a contracting economy like we are right now, things are slowing down. They're going to take that available credit and they're going to be, this could be a problem if she uses all the money. Also, what happens a lot of times during this time is that people take a look at your credit lines and they'll say, oh, she's got 20,000 here and 20,000 there and 20,000 here. We're going to cut her credit limit to $10,000 because we don't want her maxing out all of these and then unable to pay them and us take a loss.
Yes. And there's another question that just popped in the chat, which is, I think, a follow-up to that same question. Does income play a role? Yes, income does play a role. So, you know, if you're lucky enough to have an annual income of $250,000, you should have no problem going out and getting a $40,000 credit limit or a $30,000 credit limit, especially if you have high credit scores and high character in our 5 C's of credit. Yes, income definitely plays a factor.
Right. That goes into debt to income. They're looking for your ability to have a low debt to income. So your income always affects how much credit you can get. That's in conjunction to your credit score.
Yes, absolutely. Brian, we're running a little late, so.
All right, I'm going to go faster here. So I don't know what time it is, but secured credit cards. This is the better way to build or rebuild credit. You can go to a lot of places. We have a great one here at Atlantic Financial where you can put $500 or more into a savings account. That savings account is locked, so you can't take the money out of it. But in exchange, we give you a credit card with a credit line of $500 or whatever it is you put into the account, and you can use it. You pay your monthly bills on time, you utilize the credit okay, and after a certain period of time, that secured credit card becomes unsecured and your savings account becomes unlocked. It's a real good way to show that you can handle credit. It really helps your credit score as long as you're doing it right. Now, it doesn't overcome things like too much debt or too much utilization, but it does help with other things.
Yeah, and just to continue that, you want to make sure that anytime you're looking at a secured product, you're trying to avoid products that have annual fees. You're already securing your cash to finance this this credit card, and you're being charged interest to use the credit card. So don't pay an annual fee on top of that. Atlantic Financial does not charge an annual fee for a secured credit card. So if you are in the market for a secured credit card, keep your eyes on those annual fees, and don't pay an annual fee for a card that you're financing.
And then credit builder loans. These are a lot like a secured credit card, but instead of a credit card, it's just you put the money into an account, it's locked, and they give you a loan against that one. It shows a different trade line, a different type of loan, and that can help with your credit, your credit score, and people who view your credit because it's showing different types of loans that you're able to pay on time.
Absolutely. And those of you guys who are interested in buying a house, or a car, or interested in building your credit to pursue a purchase, it's great to have two trade lines of credit history. So, having an installment loan and having a credit card is going to boost your score faster than just having one or the other. A lot of mortgage providers need to see 24 months of payment history. So that's one trade line for 24 months or two trade lines for 12 months. So that can help get you to your end goal faster by having two forms of credit working simultaneously, providing you with positive payment history.
Absolutely. And then there's alternative credit scoring. If you don't have a lot of credit history, you can replace things like these trade lines, credit cards, personal loans, car loans, mortgages, with things like rent and electricity and water bills. The bills that you're paying, as long as you're paying them on time, they may be able to be used instead of the other things. If you're not paying on time and you turn them in, it won't hurt you, but it won't help you either. And Jimmy will talk about a program that he's heard of that uses alternative credit. But keep in mind, lenders don't have to use alternative credit at all if they don't want to. That's up to the lender.
Yeah, so what Brian's talking about and what I talk about in here is, if you guys have probably seen the ads either on TV or Facebook or wherever you're seeing ads for Experian Credit Boost. That's what it's called, Experian Credit Boost. That's what this is. So you submit your PG&E bill and your cable and internet bill and your utility bills and your things like that to Experian, and they calculate it into your credit score and boost your credit score. Now, you may see a superficial boost in your credit score through that, but keep in mind, like Brian said, not every lender recognizes alternative credit reporting, so it may not help you when it comes to applying for lending products. That those things don't necessarily qualify.
Absolutely. All right. Your credit responsibilities. So these are things that we've already talked about. I'll try to run through them pretty fast here. Borrow only what you can repay. Don't bite off more than you can chew, as the saying goes. Read and understand your credit card contract. Make sure you're going to get that when you get the credit card. If you don't like it, cancel the credit card. But they'll tell you things about due dates and late payments, and all that is in your credit card contract. Pay your debts promptly. Again, don't pay late. Here's some more. Follow your agreement. So, if it says your payment is due on the 15th, pay on the 15th. Pay online, it'll give you more leeway. If you pay online and the bill is due today, you more likely can pay today and not be late. Keep your balances low. You want to stay under that 35% utilization as much as you can, and read all important information. Whenever your credit card or lender sends you something, I know it's so easy just to say throw it away, but at least read over. Usually there is a summary of what is included in there, so you can get an idea. And if something is something is of interest to you, then you can read some more. We have a question.
We do, and I'm gonna. That's a great question, actually. Does closing or canceling a credit card lower your credit score? And the answer is yes, it can. Whenever you close a trade line, specifically credit card trade lines, that payment history does one of two things. It gets removed from your life of credit, meaning the length of time that you've had credit, and it also, the payment history stops contributing. So if you went out tomorrow and closed all your credit cards down, you would actually have a 0 credit score because all of that payment history is no longer contributing to your credit. And now your life of credit, meaning the length of time you've had credit, is at 0 also because all those years you had that credit card are no longer contributing. So we typically say, don't ever close your oldest credit card. If you have had a credit card for 20 years, don't close it. Now, here's what I'm going to say to that. If your first credit card you ever got charges you a $100 annual fee and a $5 monthly fee to have your credit card, and you got a credit card 2 years later, close the credit card that's charging you a $100 annual fee and the $5 monthly fee. Don't pay fees, monthly or annual fees for credit.
Yeah.
Go ahead, Brian.
I was going to say the other thing to keep in mind is that the hit from doing that, although a hit to your credit score, is not horrible. And once again, it's the worst the month you close the card, and then it starts to lessen its effect quickly afterwards.
Yes, but yes, closing an account it does have an impact on your credit score. So you know, if you have a card that you might not be using, but you've had it for 10 years and they're not charging you any fees, it may be beneficial to use it once a year to spend $50 just to keep the card active, so that you don't miss out on that positive payment history and that credit life that you have available.
Absolutely. Don't skip payments. I know a lot of places, including us, have where you can skip a payment, but when you do that, you're extending the interest you have to pay and the length of time in which you have to pay the loan back, and that can be a slight negative. Don't go over your credit limit. That will be a definite negative on your credit. It's very important to stay within your credit limit. And a lot of times now they used to charge you a fee if you went over credit limit. The government said they can't do that anymore, but now they can make your minimum payment include every dime that you're above your credit limit plus your minimum payment amount. So you want to really, really make sure you don't go over your credit limit. Minimize your use of cash advances. A lot of places you can pay almost double the interest on a cash advance as you would with the purchase. We are not one of those places, but some places you can be. And don't buy credit card protection plans. They charge you a lot of money, and it's very hard to get what they protect. It's very hard to get them to pay when you need it to be. And here's some things to remember that I'll let Jimmy cover this screen because he invented this one.
Yeah. So these are things that you might not realize your credit has an impact in. Your credit can impact your ability to rent a property. It can impact the amount of a security deposit you have to pay. Sometimes a landlord may say, you're going to have to pay me 2 months security deposit instead of 1 month security deposit because of your credit score. Landing a job, 47% of employers check your credit before you start. Your credit can impact your ability to work places. Atlantic Financial ran my credit before I started working here, and it could have impacted my ability to work here if I had negative credit history. Water, gas, and electric bills, they can all require you to pay a deposit to turn your BG&E service on if you have poor payment history. Home insurance, your home insurance rates can be higher if your credit isn't where it needs to be. And the same thing with car insurance. Sometimes as much as 25% higher because of your credit.
So Coffee is our free and unlimited financial education and coaching. You can access Coffee through our website. There's a place to go. You have to register. It is free. Don't have to worry about writing this down. You're going to get a flyer about Coffee in your email tomorrow. But It covers all kinds of things, which we'll see on the next screen.
I don't think this one has that screen. Oh, yes, it does. Good, good, good.
It's just it's in the reverse order how we
Exactly.
normally are. So things like budgeting tools and videos and webinars and podcasts, not as good as our podcast that Jimmy will tell you about, and live chat with financial coaches. And they'll help you with things from budgeting to understanding your credit report, advice with credit restoration, advice on paying down debt. If you are in really bad shape and you really are getting behind and you can't make the minimum payments, they do have a debt management program where they'll take over making your payments and they'll work with your creditors to lower your payments. But that costs a fee because they have to run this program and they have to have someone work with you and to pay the payments and make sure things are being paid and work with the credit card companies. So that fee is less than you would pay with a for-profit company, but there is still, that's the only thing you pay for. Again, this is all free for Atlantic Financial members, and we don't know what happens when you call there. All we know is, and we don't even know who calls there. All we know is that 8 people today called, or 8 people went online today. That's all we ever know. You also can speak to a financial counselor at AFFCU. There are 4 of us. We'd be glad to help you with all of these things. And it is all very private and confidential. What we talk about, if you talk to me, is between me and you. It does not go back to the credit union management or staff, what we talked about.
So that's the end of the content of our seminar today. This is your chance to ask any questions that you guys haven't asked already. We really appreciate you guys taking the time to ask those questions throughout. That's really helpful for us to be able to answer everything that everybody's looking to have answered. So this is your chance to add some more questions in there if you have any. I'm going to bring up the next screen that has mine and Brian's contact information on it. That is also going to be in the email. I also just like to look at this picture of me back when I used to be able to go to the barber. It makes me really happy. Can't do that anymore. But if you have any questions, you can reach out to us anytime. If you need some help with anything, we're available. I'm going to stop the screen share. You guys can continue to enter any questions you can think of, but I'm just going to show you on our website where you can go and see what else we have going on. So if you go to our website, right at the top, you see resources and financial guidance. That's where we are here. And right here in the middle of the screen is the view monthly calendar. And if you look at that calendar right here, we have all of our seminars scheduled right here. All the things that we have going on this month, you can click right here. If I were to click on this link, maybe I will. If I were to click on this link, it will take me to the registration for that particular seminar. Can you all see that, Brian?
Yes, I can see it.
Okay, it takes you right to that direct seminar that we're talking about, that I clicked on. We have more credit-based seminars coming up. How to read your credit report is another seminar we're doing, as well as how to live debt-free seminar is a great seminar that we're doing. If you guys have kids or grandkids or nieces and nephews, we're doing a class for kids and teens on how to use technology and money. So please share this information. It's going to be attached to the email we send you with any of your loved ones or friends, whether they're members or not, so that we can help them out the same way we're helping you guys. So looks like we got some questions.
All right, so the first one is, can you do retirement planning through coffee? Yes, they can help you with IRAs and some retirement planning. No, I don't believe they have any certified financial planners. So if you need more like investment kind of help, you can contact me at the credit union. We do have some outside partners on the financial planning side on the investments because we don't do those at the credit union. And then this other one, and I haven't heard of this one, so we're gonna have to look into it for the person, is what should we know about FICO 10 that rolls out this summer? Maybe you know, Jimmy.
I don't know. What I will tell you is I wouldn't be too super concerned. And the reason why I say that is because, you know, there's a new FICO all the time, and not everybody uses the most recent FICO. So for example, I think we're still using FICO 7. So it's really, when you're talking about different FICO models, you're talking about a slight change in the equation. So you're talking about a slight change in the impact of payment history versus utilization, or, and there's a FICO auto score and there's a FICO mortgage score. So, when you go to the car dealership, some of you guys might recognize, if you ever apply for an auto loan at a car dealership, that your score is much higher or much lower than it usually is. And why is that? That's because they take your auto payment history and they put it right up here at the top, and they say, we really just care about what your auto payment history looks like. You can not have paid your credit cards, but if you've paid your auto loan on time, we want you to have a higher score. Whereas in reverse, when you go to apply for a credit card, they're going to flip those things. They're going to say, we don't care as much about your car history. We want to make sure you're paying your credit cards. So I wouldn't be super concerned about a new FICO platform coming out. I honestly have not heard about FICO 10. I'll have to look into that now that you brought it to my attention. But I wouldn't be super concerned about a new model coming up.
And the person who wrote that, if we find out anything that is alarming or drastically different, we'll send you an email.
Yeah, absolutely. But I wouldn't think that would be the case. Before we let you guys go, if you have any more questions, type them in right now. Thank you guys so much for joining us, taking time out of your evening. It was awesome to have some of you guys return. Please share this with your friends. Also, shameless plug that I've plugged in everything we've done so far. Please check out our podcast, AFFCU's Financial Power Podcast. New episodes drop every Wednesday. One just dropped this morning. You can see it wherever you get your podcasts, and you can listen to Brian and I talk for 20 minutes. It's a great time.
Yes, and as I've said in other ones, so if you've heard it before, I'm sorry, but really go check it out. You'll see what superstars me and Jimmy are going to be. We're going to be discovered any day now, and we'll be off to California. So then you'll be able to tell your kids and grandkids that you got to talk to us way back before we became famous.
Yes, Brian is very modest. Very, very modest, Brian is.
I kid. We're not going anywhere. Me and Jimmy will be here for decades to come.
Decades. All right, guys. Well, thank you so much for joining us today. We hope you guys got some great information out of this. We hope to see you at another seminar, and we hope you invite others to join you as well. If you guys have any questions, or if you need anything, feel free to reach out to Brian and us at any time.
Thank you very much, guys.